Good evening and welcome to this webinar in association with Tickmill. And tonight's webinar is called Technical Approaches for Using Moving Averages. My name's Charlie Burton. For those of you who don't know me, I've been trading for 28 years now. I've featured in BBC documentaries. I've been in the Financial Times and all the major publications over the years, talking about trading and the likes. I've been in trading competitions, all the usual sort of stuff, and I'm a money manager here in the UK. Tickmill are the sponsor of the webinar tonight. They are a very good broker, and of course, I'm going to say you're going to say, "Oh, he's bound to say that," because, but they really are. I've been dealing with Tickmill for 2 or 3 years now, and do check them out if you're not with them, if you're not currently with them, because their charges and their fees are really low, like really good. So well worthwhile checking out, and they're a great team. I'll give you their details in just a minute. Before we go any further, though, we have to go through the usual disclaimers that the material provided is for information purposes only and should not be considered as investment advice. The views, information, or opinions expressed in the text belong solely to the author, that's me, and not to the organisation, committee, or other group or individual or company. CFDs are complex instruments and come with a high risk of losing money, etc., etc. Okay, I'll leave that for you to read. Right, let's get into the webinar here. This webinar is all about moving averages, and I think that we're going to start off with some of the misconceptions with regards to moving averages. But I always think if you can just keep this line in your mind, if you're using moving averages, it's really useful. Moving averages are simply an average of price. Reword it. Because people say, oh, moving averages, they're just a load of squiggly lines on a chart. And they're not actually considering what they are. They are an average of price. And we'll be staying on that theme as we go through this here this evening. So what will we be covering? Commonly misunderstood applications. And so no doubt there will be people here this evening who will be thinking, oh, moving averages, aren't they, this, that, and the other? So we're going to go through all of those misunderstood applications. We are going to show a simple pattern, but we're also going to show price up, price down, MA up. What pattern is that? So we're going to cover that as well. Dynamic pricing too. Before we go any further, though, as always, do take a note of this web page, tickmill.link/my name, Charlie Burton. So it's tickmill.link/Charlie Burton. If you do that, hopefully I've got it here to hand. There we go. That'll bring you to this microsite, which has been put together by Tickmill. And it's got the webinars, the past webinars in here. I have noticed that December's isn't in there, so I will speak to them and ask them if they can put that up there. Tonight's one will go on to here. So if you ever want to go back over any of the previous webinars, then do make a note of that link. And it's got the webinars. If I hit the arrow here, there's a load in there. And also there's some tempters here from Tickmill. If you wanted to join my live trading room, then there's ways of doing that if you open an account with Tickmill as well. Right, let's get back to the webinar here. That's the link there if you wanted to do that. And then lastly, if you need a point of contact at Tickmill, do write down and get in touch with Giuseppe. If you're looking to open an account, he's an account manager there and he will look after you. Oh, thanks, Asim. So it's Giuseppe@tickmill.com. Everybody send him an email. It would be great if he wakes up tomorrow, because he's over in Italy. So if he wakes up tomorrow with 200 emails, that would be brilliant. So anyway, yeah. So if you're looking to open an account with them, email Giuseppe and or you can open an account, I think, through that link anyway. I think through that link, yes, you can. But by all means, it'd probably be quite good to send Giuseppe an email and say hi. Okay, let's get going. So let's start off with the misunderstood applications. Common language that I hear from people and is are things like, "Well, moving averages, they're just a lagging indicator, so they're no good." Okay. What that tells me, if someone says that line, it tells me they don't truly understand moving averages. So, but we will cover that off. Moving averages gets you chopped up. That's another common thing. And both of those lines actually are correct. If they're used in a given way, then yes, moving averages will get you chopped up, and moving averages are a lagging indicator. So both of those statements actually are correct. But there are ways of using moving averages that does give you an edge. So that's what we're going to be exploring. But first of all, let's have a look at some charts to go over some of these misconceptions, first of all. So, firstly, I've got a chart up of the euro dollar. So this is a daily time frame, and I've got at the moment I've just got two moving averages on here. I've got an 8 period moving average and a 20. It doesn't matter if it's an 8 and 21. Don't worry. Use whatever you want to use as far as moving averages. It's just for the purposes of this example. So as I've already said, we're talking about the misconceptions. So this first arrow here, at the point where the moving averages cross, very often by the time they've crossed, price actually is right up here. So that statement, as I've said, is true. So if you were trying to buy or sell when moving averages cross, more often than not, you're going to be getting in a little bit, probably not the best price. Yeah. So we can certainly agree on that. So we have to do a bit more than that. And it's the same over here to the right. So by the time the moving averages cross, price is actually right down here. Now, yes, with the benefit of hindsight, we can see that price carried on going lower, but it's still not necessarily a great entry at that point. So I'm just making the point at this moment in time that yes, using moving averages in a traditional way of just crossovers, uh, for most retail traders, they wouldn't be able to handle it. Now, if I go to the next chart here, I've got this big circle around this whole period here. And every time, if you bought after every time the moving averages crossed to the upside and then closed out every time they cross back down, you just wouldn't make money, not during this choppy phase. Because moving averages will chop you up when markets are not trending. So when they're trending, they're great because if we take this sell signal back here, well, yeah, okay, so you can get chopped up a fair bit there, but if you've got a bit of risk management and you've got stop losses involved, then yeah, you take some losses through here. Not every single one of them wouldn't have been a losers, but you'll have a few losers, and then you go and get the mega run all the way down until probably about here. So yes, moving averages are lagging if you're trying to use them in that way. That's not what we're going to be going through here this evening. So we need to use them differently. Remember, they are an average of price. So let's bring up another chart here and just start to delve into the chart. In fact, Adam, you saying earlier on you're using a 50-period moving average. This chart now is a weekly chart, still of the euro dollar. I've been using the euro dollar for most of my examples here tonight, and on the weekly time frames. This black moving average is the 50. All of the moving averages that I use are simple moving averages. I don't use exponential. Nothing wrong with using exponential, But there is a reason, and I shall explain as we go through tonight's presentation why I use simple moving averages. There is an absolute reason why I have to use simple because of some of the ways I use them. Okay, so let's start off here. Like I said, the moving average is an average of price. So when price is moving away, get rid of that arrow for a second here. So when price is extending away up here, away from its average price, that's all it's doing. It's extending away, and they very often ebb and flow. So they mean revert, so they'll revert back to the average price at times, and very often they'll then bounce back away from the moving average itself. So things like angle is important. So if I now put the arrows on, we can see that the 50 period moving average during that up phase was nicely facing up. That's important. We're going to come back to this in just a few minutes. And likewise, during the downwards phase here, yeah, the 50 moving average is facing down really nicely. So again, generally speaking, we want to be trading in the direction of the moving average. So if whatever, and of course the moving average is just a visual representation of what price is doing anyway. So that's fine. But so you don't, in theory, you don't have to have a moving average, but as I say, it's the average of price. So when price comes back to its average price, like in this example over here, then sometimes that can actually make for a nice trading opportunity. I'm going to come back to that as I've just said. So when we're angled to the downside, yeah, it's just a visual reminder. Because look, I have a live trading room. This is going back into 2021 and 2022. When people right now, it's easy for people to say, "Oh yeah, it's a downwards trend." Not in real time. Well, it still is in real time, but there'll be what I'm trying to say is there people are trying to catch the bounces all of the time. Now, there's nothing wrong with that as long as you are well aware that you're trading against the trend when the bounces come in, and that they may well just exhaust themselves. So there's nothing wrong with trading against the trend as long as you've got your risk management, and you're using stop losses, and you're well aware of that. Hopefully, you're also when the bounce is exhaust and price starts to rotate back over, you're also trying to short the market as well. But like I said, I was trading with traders during that period, and traders are always trying to go against the predominant trend as well. So sometimes it's just a nice visual reminder of, even when you're in a phase like this where there's a bit of a retracement phase, it's just that reminder that look, the trend overall is down. So whatever this retracement is, we have to assume it's just a retracement until proven otherwise. Have I got any other arrows on here? Even through this phase coming into 2023, um, the moving average had turned up here. So again, even during this, and I'm going to talk specifically about some of these moves in a moment. Even on this pullback here, there were reasons, and I'll be going through them in a minute. One of which is the moving average angle was still facing up. I'm going to go through that in just a few minutes. So to still be looking at the long side. And then even through this period here, the moving average goes a bit flat. So yeah, okay, it's just then confirming that, yeah, okay, price is getting a bit choppy. Right the way through, in fact, to where we are right now. All these slides I took, I've literally like to put the example slides in as late as I can. So I was putting all these together for you just literally this morning, these screenshots. So Right now, where's the angle? Well, the angle's to the downside. So again, right now on the euro dollar, the moving average is facing to the downside. So that's telling me that that's where the predominant trend is until proven otherwise. Okay. So it's not to say that I can't go counter trend and look for an up move, but I have to acknowledge that that is what that is. And there's nothing wrong if I had things like divergences, then of course I could trade counter trend and mean revert for potentially maybe a run back up to the 50 period moving average. But that's a different strategy overall. But overall, right now, the trend is to the downside until proven otherwise. Okay, see if we can get this right. So if price retraces to its average price, that's going to be an area of interest. So if price retraces to its average, that's an area of interest. What I'm trying to say there is I would be looking at it as a dynamic area of support or resistance. Talked about dynamic pricing. It's a dynamic trend line essentially. So if we go back, the 50 period moving average it is essentially like a trend line. It's a trend of price. It's the average price. So when price comes back to its average price, well, I should be looking at this zone here as a potential buy point. I'm going to talk all about that in just a moment. If the average price is sideways and it's just telling us there's no trend, like I've literally just hinted at, we can use them as support and resistance to potentially trade off of, and we can use them as targets. So when we're doing like a mean reversion trade or a trade off of a divergence, then I can use the moving average as a target. And I'll go over that, I think, right now. Yes. So in fact, this is that same chart. This period here, this what I'm going to go through now are some actual examples of trades that I've been in over these recent years on this what week on this looking at this weekly time frame here. This was a trade coming into the end of 2020. It was the December of 2020. We were making these new highs. The sentiment, if you haven't seen my webinar on sentiment, go back to that link that Alliston kindly put up and go to the previous webinars. I did a webinar on sentiment and do check that one out because at the high up here, there was euphoria. From a sentiment perspective, loads of bullishness, lots of articles all being written about why the euro was going to carry on going up against the dollar and why the dollar was going to carry on weakening. And when you start seeing all of that euphoria there from a sentiment perspective, then you have to look the other way. So it just so happened at that time, at around these highs here, we had a technical divergence. So from this high here, so if we say that's point one to point two, there was a divergence. I haven't got my divergence indicator on, but anyway, there was. So you can use RSI for divergences. You can use MACD for divergences as well. So when I was shorting through this phase, it was about a 3-month period. That was from the December through to the March. Where was my target? Funnily enough, the 50 moving average. And then almost immediately I reversed and then reversed back to the long side. Now, for those of you who say, "Oh God, here we go," that's Yeah, you're just telling us this. I have no vested interest. It doesn't matter to me. I'm telling you what actually happened. And what actually happened was I was in this long here and I was still in it and it rolled over. So I ended up actually just getting trailing stopped out. So there you go. So, but it was still a lovely trade. I just had elected it hadn't quite got up to my target. I think my target was up here. And so it rolled over and I got trading stopped out. So there you go. So, but it was still a great entry. That's my point. Now, down there, for someone like Adam, who's looking at using 50 period moving averages, there's a couple of things to note here. Look at the angle of that 50 period moving average, sharply facing up. If price is coming down into a moving average, which is sharply facing up, there's very good probability that price is going to bounce. Even if it just shuffles the other side of it, it's likely it's still going to bounce back up. So angle is important. So yes, I traded that. Anyway, through 21 to 22, the previous high didn't hit the 50 SMA. Did you take that trade? Oh, what previous high? Didn't hit the SMA. Well, it did hit the SMA here, so I don't know what you mean there, Kevin. What do you mean? This one here, the previous high didn't hit. I don't know quite what you mean. You'll have to write that out, Kevin, again, and just explain what you mean. The previous high didn't hit the SMA. I don't know. Um, yes, absolutely, Dylan. This does not matter that I'm showing a weekly chart. This could be an hourly chart. It doesn't matter. The previous lower high in the trend. Uh, oh, when it came here. Oh, yeah, it didn't need to come back to the 50 at that point. No, yeah, no, it didn't need to. It was only once we'd got a technical divergence. So we had a technical divergence at that point as price made the new high. Then I'm looking for it to come down. Yeah. Okay, let's move on. So that was that. Fine. Rolled over. Then we got into 2021 and I didn't start actually shorting in 2021 until the September. Somewhere around here is where I started shorting. Because of course I'm looking for confirmations on other time frames as well within my analysis. But by that point, what's happened? You know, the moving average actually is starting to roll over. Plus, there was other analysis that I was using. So then, through that whole period, yes, I caught pretty much every rollover during that because I knew that I wanted to be trading in the direction of the of that trend. So every time we started rolling over after any of these bounces, yes, I was trading it on the downside until, funnily enough, right down here at the lows, the euro dollar hit a significant low around 95. It was about 95, 95.35, I think was the low. In the September, I think it was, of 2022. And what happened at that point is the sentiment down here was not euphoric, it was pessimistic. So it was the absolute pessimist. Anyway, probably typing that wrong. It was the absolute opposite. So no one wanted to own the euro. All the articles were now coming out about how the dollar was a wrecking ball, and there's no end in sight to the dollar's strength, and that's exactly the sort of articles that we had at that point. In fact, have I still got it to hand? I probably haven't got that headline not to hand. No, so I knew at this point, we've come in structurally into a historical low, going way back to 2002, and we've got this huge amount of negative sentiment. So I knew that we had the chance, and we're stretched away. If we're looking at mean reversion, price is quite stretched away down here, away from the 50 period moving average. So I didn't get long right at the low. No. But on the daily chart, I think it was about, oh yeah, it was about 98 on the 4th of November. I remember it well. It was a non-farm payrolls day and it was about 98 down here. And I ran that back to where? The 50 moving average at around about 105-ish area at that point. Banked some and then ran the rest, fun enough, and I kid you not, the final part up to 110. But the moving average was important. I want to respect the moving average. As it turned out, it just price just went through it. But I was using it as a target for this mean reversion trade. So over and over again, I'll be using the 50 period moving average. If you ever said to me, Charlie, if you could have one indicator to trade with and no other, what would it be? I would tell you it'd be the 50 period moving average. I've been using it since 1997. So for whatever that is, 28 years now, pretty much, maybe 98. Um, and that would be it. Now, again, it's a personal thing. You know, if I asked everybody who's here tonight, well, what indicator would you use? People would come out with a range of answers. So there's no right or wrong. It's just what's personal to you. Okay. Again, a mean reversion example was happened back here. We made these highs into 2023, into the summer of 23, and we had a divergence going on again on on the MACD. So somewhere about here, I shorted for what? A run back down to the 50. So I banked some of the profit of the 50 and managed to run a little bit more down to here. Now, this bit got really interesting because down here, or down in this zone down here, price overshot the 50. But what was the 50 doing in real time? Still sharply facing up. So on the smaller time frames, I was looking at getting long. So I managed to get long on the smaller time frames down here because the 50 at that point is still facing up sharply at that point. I want to be long. I'll talk about that a little bit more in a minute. But again, a mean reversion there. And I think that's all I've got on that chart. Right. Okay. So overall, the power of the moving average to use it with the trend when I'm long or short, but also if there are divergences, then I can use the moving average as a target. Okay, this one is called price down, moving average up. I'll give you a little hint. That's exactly what I've just been talking about. So back in this example here, price down, bring my pen back up, price down, moving average still facing up in that example there. So, right, let's go back over to the slides. Again, just to reiterate, all my moving averages are simple. If I used exponential moving averages for this, it wouldn't work because exponential moving averages are weighted to the most recent data. So they move around a lot more. I don't want my moving averages moving around a lot more. They leave clues. Price leaves clues. Moving averages are what? An average of price. So if price overshoots a moving average, but the moving average is still facing up and price comes into support, then look for it to bounce back to the upward facing moving average. So let me just bring the pen on here. So we've got an example where price has been coming down and the 50 period moving average, our 50 here, is still facing up. But price is coming down and it's hit a support zone. Oops, whatever the support zone is. If you see a pattern like that, more often than not, price will come back up for the 50. it'll come back up to the 50. So price down, overshooting the 50, but the 50 still facing up. As long as you've got support here, of course, you want to find technical support, then it'll start to bounce and it will ride its way back to the 50. It's a neat little technique that you can wrap a strategy around or whatever. I use this in my trading all of the time. Like I've just said, actually, if I go back to that last slide there, that was a genuine trade down there in whenever that was, October of 2023. Moving average up, price was down here into prior lows. There were technical divergences on the smaller time frames at that point, bullish divergences. So I used those to then trade back up. Obviously, I'm always looking at other analysis as well, but that was part of it. So let's go over to maybe another example now. Oh, I've already got it. That's the example there. And I think I've got another one here. This one I took literally from the euro dollar from yesterday. So, and this is on a 4-hour chart. So I literally took this well, I took the screenshot this morning. So price down here, as you can see, has overshot the 50. This is on literally, you can look at this yourself. 4-hour time frame. Price overshot. It's come down into this prior price zone down here, but there's something else I'm going to show you as well that it came into. What did it then do? Bounce back up. You could use this on like a 5-minute chart. If you're an intraday trader, you could use it on a 5-minute chart. So it's a pattern, like all of these patterns, we can use them across any time frames. So it's a nice little example there. In fact, I've now got another moving average that I want to show you. My yellow one here is the 200 period moving average. Sorry, I can see there's messages, but I can't answer them at the moment, as I lose my flow. So I'll come back to your questions in a moment. Although Karen has said, does it matter if it's an EMA? Yes, it does. As I keep saying, it has to be a simple moving average for this type of trade analysis. Maybe I'd already answered that. Maybe you'd already put that question and then I've answered it maybe already. Right. Okay. So the 200. So what do moving averages can act as what? Support and resistance as well. So not only had price come down into technical support zone, it was also pulled down into that 200 period moving average, and then it had its nice little bounce back there. So that's a very minute example. It doesn't matter. It on a 4-hour chart, it's gone from whatever the level is down here, 103.90, let's call it, and then bounce back to 104.20, on a 4-hour time frame. This is a lovely, neat pattern that when you see an overshoot of a sharply upwards facing 50, then if it comes down into support, more often than not, it will bounce. Of course, you still have to put a stop loss, technically on your chart and all of that, but it's a great little ploy, and I use it regularly. Okay. Well, that's an interesting question there, Kevin. So you're saying about the 200 is in a downtrend at that point. It is, but it's flattening off a bit by this point anyway. And so, yes, is there much else I can say? This is a short-term trade. So it's only a short term. It's a bounce trade, isn't it? Back to the 50. So that's all it is anyway. So yeah. Right, now we're moving over to what we're calling here the golden setup. We're going to take that 200 period moving average, the yellow one on my chart, and how are we doing for time? Right, and we're going to apply that now, because this is probably the most common moving average setup is golden crosses and death crosses. So a golden cross is when a 50 crosses upwards through a moving average. Yeah, yes, Sean. That's why. Were you here at the beginning, Sean? Because I've covered all that off at the beginning. So, hence why I'm showing them how I'm showing them. We're not trying to use them for crossovers. However, having said that, I'm going to show you a moving average crossover. I'll have to come back to all your questions because I'm going to get caught up in your questions. I'm going to show you a moving average crossover that you can trade. All right. So a golden cross and a death cross, they are famous in technical analysis. They're probably one of the very first moving average crossover techniques that was ever devised. Golden cross, death cross. So 50 crossing up through the 200 is a golden cross, and a 50 crossing down through the 200 is a death cross. However, as you guys are quite right, and as we covered off at the beginning, that is massively lagging because these are two longer term moving averages. So by the time they cross, they can be, price has long since gone. How the heck are we going to use this, Charlie? Well, let's go and have a look. I used to use this, I devised this, so to speak, decades ago, a couple of decades ago for intraday trading, what I'm about to show you, but you can use it on any time frame, like all of this stuff. So let's actually bring up some examples first of all. So what have we got here? A golden cross here, where the 50 crosses up through the 200. What's the problem? Well, by the time that's crossed up and given and crossed through, price is right up here. It's massively lagging and delayed. You can't actually use it, not as a signal to buy. It's a confirmation of what's already gone, but you can't use and trade off that specifically. Not a retail trader can't. Why am I saying a retail trader can't? Because there are money managers out there who won't care about, and because historically these were systematic, at least should I say, in the 80s, where money managers would buy and sell based on golden crosses, and they don't mind that they're getting in late, because if they're looking at a market that may end up being in a massive trend, it doesn't matter to them if they're getting in here, if price is going to go a lot higher. A retail trader just won't like that, and that's why. Now, as far as death crosses are concerned, we've now got one over here. And so again, by the time the death cross comes in, price is miles away down here. And a lot of the time, by the time you actually get a golden cross, if price is extended away, it's usually about that point that the price is actually about to retrace a bit. And it's the same down here. By the time the death cross came in, price is actually about to retrace. So what they are, though, as I've said, is they are confirmations of what's already gone on with price. So yeah, you wouldn't trade it as a signal, but it will at least confirm. You say, "Oh, okay, yeah, the medium term confirmation of what you can already see in price is, yeah, okay, is to the downside." Okay, but how can we actually trade this stuff? Right, let's go on to another chart. Let me just make sure. Okay, I'll go to this one first. So price here has pulled back now as the golden cross is actually happening. Very different. Price isn't extended away at that point that the golden cross happens. So if price is pulling back as the two moving averages are crossing, there's a buy signal. So you can use them. I used to use this on like a 5-minute chart years ago. So you get a golden cross, but the price isn't extended. Price is there as the golden cross is happening. That is a buy signal. In fact, if you look at the chart here, but just turn that off. It's quite interesting because price, as you can see down here, it's so marginal, it's nothing, but actually went marginally below the 50. Look how steeply upwards rising that 50 was. So yeah, a nice angle there to the 50 as it's then crossing through, and price wasn't extended. So great uh, example there of, I didn't trade this, by the way, this is on bonds, but it's a great example of a golden cross happening at the same time that it's happening, price is there. It's pulled back into it as it's setting itself up. Much like if I go back to here, this is the same in reverse, because this is the last chart was the yield. This one is the 10-year note itself. So this one's a death cross. So price has come up, is still there as the 50 is crossing the 200, giving a confirmed sell signal where price isn't extended. It's not right down here. It's there where the two moving average, as the two moving averages are crossing. It's a nice little simple technique. Go back and test it and have a play with it. Yeah, you're going to have to devise a stop loss, appropriate stop loss with it. You can use an average true range to do that. But it's such a neat little setup when they happen. They don't happen that frequently, but it's a nice little setup. So have a look at it. So it's a nice little setup there. Oh, that's the other one. Right. Okay. So I've said I've been trading for 28 years, and I've personally been using everything you've seen tonight for probably the last 25 years, using moving averages. They're very graceful using moving averages. So do try to incorporate maybe one or two or whatever into your analysis. I've given you a couple of ideas tonight about moving average angles, when price overshoots them, golden crosses, when to use them for golden and death crosses, but overshooting of moving averages, price mean reverting and back to moving averages, and using them as a target as well for that, and using them for bounces off of if, especially when the angle is solid as well, a nice 45-degree angle as well. So I use them all of the time. So I use a cluster of moving averages. I use a 5, an 8, a 20, a 50, a 100, and a 200. You don't have to use all of those, but I'm just telling you what I use. Do you have to have a 20? Could it not be a 21? Yeah, absolutely. It's a personal thing. And so all of mine are simple moving averages for all the reasons that I've said earlier on. If I used exponential, it would be bending over like this. You know, my little example of when price comes below, comes below the moving average. Well, an exponential wouldn't give me a setup because it moves very quickly. So no, I like the fact that simples will still carry on going in a given direction for at least for a period there as well. Moving averages are a graceful way, like I've said, of trading the markets. We're using them as dynamic support resistance. They're like a dynamic trend line. And always keep it in mind. Don't think of them as squiggly lines. Always keep it in mind that they are an average of price. They are the average price. And if you think about it that way, you see when price is stretched away from its average price and then it moves back towards it, sometimes it overshoots it, you start to see all this stuff coming through. Mark Douglas, the late Mark Douglas, who wrote probably one of the most famous trading books called Trading in the Zone. Many of you will have read it. I met him in 2002 over in Chicago, and I remember him saying, "Yeah, I tell traders all of the time, if you locked someone in a prison cell for 6 months and just gave them a 10-period moving average on a price chart, they would find a way to make it work. The problem that everybody has is we have so much choice." So even in 2002, there was still plenty of things we could put on our charts. So anyway, I like using them. I use other analysis, of course, as well, price itself, of course, and trend lines and support and resistance, all the other stuff. But that I find them a nice visual entity to have on my charts. So, like I've said, we can use them as targets, as entry levels, and as a heads up for overall direction, giving us that visual clue there. Oh, what have we got here? Final thoughts again. Yeah. Oh, okay. So it's just that link again, tickmill.link/Charlie Burton. The webinars are on that page. So the past webinars over the last couple of years, I don't think December's is on there. So I'll ask them to see if they can get that up there. And do email Giuseppe@tickmill.com if you have any questions about opening an account or anything like that. He is your man. He's my point of contact. He's your the person to fire an email to. But do check out the site as well because there's some plenty of information on that little micro site. And I think, yep. And then we're back to the uh, disclaimer page here. That does bring us. I said about half an hour, didn't I? So it's 45 minutes. Brings us to the end of the officially the end of the webinar. But let me have a look at your questions now because I just get to a point where I just can't keep up with all the questions. So what I'm going to do is start reading through some of these later ones. Okay. Karen, I think we answered that. Brett, thank you for answering Karen's question there. You've always used moving average crossovers, but you feel that it tends to signal moves too late. Yes, Sean. So coming to Sean, your point there, I think if you're trying to use moving average crossovers as your entry signal, then you're always going to be a bit late. Now you could use a shorter term moving average combination, Sean. So maybe like a 5 MA crossing up through I don't know, maybe a 20. So price may not have run quite so far. And sometimes when a moving average crosses, much like this retracement here, even on short-term moving averages, price is actually still there. But I must confess, I don't use moving average crossovers as an entry technique. I use them as confirmations, visual confirmations of what price is doing, but I don't use them personally as a thing. Now, the death cross, golden cross, um, pull back into those, yes, but generally speaking, I don't use moving averages, crossovers as for getting in. I use them as just a confirmation, really. Um, duh, duh, duh. Which price do you use to calculate moving average? High, close, or something else? Good question. Oh, it's all moving around. You use high plus low divided by 2. I just use the closing price, Saber, for when I'm putting a moving average onto a chart, I just use a closing price. So, yeah. Can this be used as a confluence? Is a question here. Visual with other strategies like harmonics and reversals. Absolutely visual. I'm just showing you just the moving averages here tonight. If I go back to the early, right, if I go back to this early example here, when I was going through this weekly time frame, when I was shorting to take price, in anticipation of price coming back to the 50 here, and when I went long off of here, there were other things that I'm using. So yes, I was using divergences, like I said, off the top there. Down at the lows, funnily enough, I was using then bullish divergences on a smaller time frame, knowing that we've hit that key 50 period moving average. So Yeah, absolutely. And like I said, sentiment up at the top, sentiment down here at the bottom. So that when I got long, I knew the sentiment was stretched, price was stretched, from a mean reversion perspective to its 50. So yes, I'm using other things, but as well. But so yeah, absolutely use them in conjunction with your other analysis. That would always be my advice. Yeah. Because then you're personalizing it and you're using it in conjunction with other things that you already use. Yeah. You need a recording from the Zoom. Emmanuel, yeah, just go to that link that I've been sharing this evening, and the previous recordings are on there. Tonight's recording, you'll probably have to wait a week or so. I will email Tickmill tomorrow. They normally take a week or two and then they'll get tonight's one up. So unfortunately, it won't be up straight away, but hopefully within the next week. So, yeah. Alan is asking, do you tend to use moving averages on daily charts? Uh, I use moving averages on all time frames. So, whether it's dailies, weeklies, 4-hour charts, So, um, yeah, I use them on all the time frames. Um, Moving averages, are they best used for swing trading? No. As I've said earlier on, Mohammed, that uh, Death Cross, Golden Cross, I used to use that technique on a 5-minute chart years ago. So, no, you can use them on any time frame, any of this stuff. Normal period, I tend to analyze, Alan. Well, if you go back over my previous webinars, there'll be some stuff on multiple time frame analysis, I would have thought. But I start with a quarterly chart, then I go down to a monthly, weekly, and daily. I might still execute off a all the way down to an hourly chart, but I am swing trading. So but yeah, the analysis is mostly done on the quarterly chart, monthly, weekly, and a bit on the daily, of course. Um, but that's where all the analysis is done. Yeah. Jan is asking, if you haven't yet, could you show how to set up a moving average on TradingView? Yeah, I'll do that in a moment, Jan. Which moving average would you advise for intraday? Any of the ones that I've shown? I think I've already been saying that, Steve. I All of the techniques that I've been showing tonight, I've been using for decades. So, and over the decades, I've done lots of intraday trading. So yeah. Now blimey, there's still a lot of messages. So what I'm going to do is I'm just going to come out of that. Oh, where's the how to put a moving average on a trading view. So what I'm going to do is just going to take all of these off. So I'm on trading view here. I'm not going to, this is not what this webinar is about. So I'm going to be very quick. Come to indicators, come into technicals. I mean, I've already got moving averages already saved in there, but if you come into technicals, scroll down and you'll find moving average. So there it is, moving average simple. If I click on that, it's just added one. So it's just put this blue one on. If I double click on the blue moving average, it'll come up with the box. Then I can change the length of it and say I want it to be a 10 period moving average. The source is the close price. So that's what it's basing the moving average on, every closing price. So that's what you would want. Uh, don't worry about any of that smoothing stuff. You don't need that. And then you can come over to style and change the color. So that's pretty much it. It's as simple as that. Yeah, don't need any of that. So um, it's on. Now, if I change the setting to a 30, then you'll see, there we go. It's now moved. So then you just change your color and there we go. So simple as that. Let me now just get rid of that. Paul, I've already answered this, but I'll answer it again. What SMA do you use on a 5-minute chart? It's the same moving averages. Actually, if I come back over here, um, this is on a daily time frame. If I change this to a 1-hour time frame, it's still the same moving average. It just adjusts to the 1 hour. So you don't actually have to do anything different. So yeah, it's the same moving averages no matter what time frame I'm on. Yeah. Um, okay. Jamil, you're from Afghanistan. You want to open an account with Tickmill. In fact, Tickmill now supports crypto deposits. Please open an account for me as an exception. I don't work for Tickmill, Jamil. You'll need to email Giuseppe. I can't help you with that sort of stuff. Adam, is there a combination of timeframes for moving averages? For instance, price 1 hour and 5-minute moving average, 1 hour for your bias and 5-minute for entries. Yeah, if you're intraday trading, Adam, I used to use an hourly chart as my anchor chart, and then I would trade off the five. So yeah, exactly that. Usually I'd use an hourly, and then I'd quite often look at the 4-hour chart as well. And but they'd be my anchor charts to get an overall bit of analysis as far as directional analysis is concerned, and then I might execute off the five. Okay. Um, do you think time frame 1 minute gives us too many signals, and because of that, it's recommended to use at least a 5-minute time frame? David, yes, I totally agree with that. 1-minute chart is too small a time frame. So yeah. Will I be doing a webinar on divergences? Adam, if I go back to here, I can't remember. If you come over to the prior, let's have a look, see what we've got in here of the prior webinars. There we go. Multiple divergences. There you go, Adam. It's in here. It's already loaded in there. So yeah, in the prior webinars. So yes, Alan, they are. The question is, are moving averages best used in trending markets rather than range bound? Yes, generally, yes, they are. Uh, um, Yan, okay, good. Normally you'll use order flow, but we'll play around. Yeah, have a play with them. Exactly. I always say that with any technique in trading, you have to sort of get your eye in, and something's not necessarily going to come to you straight away. It's a bit like if I did a webinar on Fibonacci, yeah, and if you've never used Fibonacci before, it's going to take you time to get used to it. So it doesn't matter what it is. So yeah, absolutely. Um, Sean, I appreciate your comment there. Thank you. Hardy, thank you. Nuno, do you only trade when UK and US markets are open? And chart patterns help a lot too. Yes, yeah, absolutely. Yeah, double tops, all of that. Absolutely, yeah. Yeah, absolutely. Well, I'm more of a swing trader these days, Nuno. So I just put my trades on at any time, but I'm not intraday trading. So I might I'll put my trades on in the live market, but I'm not intraday trading. So I'll put a trade on, and then I'm usually holding it for weeks and sometimes months as well. Adam, do you have any thoughts on using Keltner channels, which are based, I believe, on a 20? Yeah, I looked at them all probably about 20 years ago, Adam, but I don't use them. So I don't really have any thoughts on that. Sorry. The link to the webinar. Yeah, let's go back to that for you. See if I can find it. Do. Someone will probably. There it is. If I click on this. Oops. There it is. Tickmill.link/Charlie Burton. There we go. And that's Giuseppe's email there as well. Uh, Good stuff. Mohammed, I appreciate your question, but it's such a broad question. You've just said some tips on swing trading, please. I don't know. um, Swing trading is no different to day trading. The concepts of the patterns that you're going to be trading a lot of the time are going to be very similar. The only difference is you need to have more patience. That's probably the main thing. So you have to develop patience with swing trading to sit on the trades and hold them to the target. So that's probably the number one tip I would give you is you need to develop patience. How profitable does well, I just saw a question there. Does a trader have to be considered consistent? It's not about how much, Jan. It's when you say about consistency, then yeah, you're really looking at probably over a time period of, I would say, 2 years plus, because you could be profitable over a 3 month period. Does that mean that you're consistent? No, probably not necessarily. So you don't know until you've been trading for quite some time whether you are consistent in the grand scheme of things. So it takes time. Yeah. Anyway, that wraps us up. Thank you ever so much for all of your comments. We're just past the hour mark now, so let's call that a wrap. Thank you ever so much for coming along. Do hope that you found that useful and some food for thought. I don't ever expect people to go off and apply it all, but there might just be one or two things that you might not have considered before. And if that's the case, I've done my job. Right. Thank you ever so much. I shall turn all of this off now. Enjoy the rest of your days or evenings.